So in this video, I'm going to explain about the relevance of interest rates, or the rate of interest. That's the shorthand that we often use, and what the relevance is for consumers and for firms as well. In the UK, we talk about the base rate, and that is the rate of interest which is set by the Monetary Policy Committee. And the Monetary Policy Committee are part of the Bank of England. And they meet monthly to decide what to do with the base rate in the UK. And the base rate, when that has been set by the Monetary Policy Committee, that then will usually flow through to banks and what they are doing. It doesn't have to be done by the banks, but generally it will be. So if the base rate goes up, then the rate of interest banks are using will go up. If the base rate goes down, the rate of interest banks are using will go down. Although, as I say, it doesn't actually always have to. They're not obliged to do that. And the main functions for the interest rate for banks are if people are going to save in the bank, or if they're going to take out a loan and they're going to borrow from the bank. And they're the two times when it's particularly relevant for the banks. And this, as we'll see in a moment, then has a knock-on effect on the consumers and the firms. The easiest way to think of the rate of interest, there are three things there. Rate of interest, that's how to remember it. There are always three things that you need to think about. If you were looking at interest rates in the newspaper and seeing whether they'd gone up or down, the reason you'd be interested is because either you wanted to save in a bank, or you wanted to borrow from a bank, or you had an existing loan. Imagine that the rate of interest goes up, as an example. If the rate of interest goes up and you're saving, the interest earned on your savings will go up. This would make you want to save more money, and if you're saving more money, you're spending less money. The second one, where it would be relevant, is if you're borrowing. If the rate of interest goes up, this would mean if you take out a loan, the interest now paid on the loan will have to go up. And if you have a high rate of interest, you're much less likely to want to borrow money and take out a loan, because you're going to have to pay more money on the loan if the rate of interest is higher than it was before. The third one, which relates to this, is if you have an existing loan. So, for example, a mortgage. When you take out a loan, you can either have a fixed rate of interest, or you can have a variable rate of interest. If you have a fixed rate of interest, that means that even if the base rate changes, you carry on paying for the period of time that you fix the rate. You carry on paying the same amount of interest. It doesn't change. However, if you have a variable rate of interest on a loan that you've taken out and the base rate goes up, the rate of interest that you pay on your loan will go up. If you have a variable rate of interest on your loan and the base rate goes down, that would be good for you because you won't have to pay so much interest on your loan, because the amount of interest that you pay will also go down. It will vary, it's variable, it will vary with the base rate. So when you're looking at a variable rate loan, you need to be thinking, what's the base rate doing? If you have an existing loan, so for example a mortgage, and you have a variable rate of interest on it, and the rate of interest goes up, that would mean that you have to pay more interest on your loan per month. And that would mean that you've got less money left over to spend on other things. So if we look, this is the example where the rate of interest goes up. You could reverse all of this with the rate of interest going down and see what the effect would be. You can then see for consumers and firms, they're going to be really affected by what happens to the base rate of interest, because that will affect how much they save, how much they borrow, and what will happen with their existing loans, how much they'll have to be paying on those. For consumers, all of these things will affect how much they decide to save, how much they decide to borrow. Remember, if you're not saving, you're spending. If you borrow money, you're borrowing it to spend. Therefore, these two things will also affect how much consumers spend, which we often call consumption. For firms, they'll be affected by the base rate of interest because they will want to know what to do with their retained profits. Pi is profit. What are they going to do with their retained profits? Are they going to put them in the bank because they'll earn a lot of interest? Also, will they want to borrow? The reason they might want to borrow is to buy capital, for example, and if the rate of interest is very high, it will be more expensive to borrow, and therefore they're less likely to borrow to buy capital. And so you need to think also here about what impact is this going to have on investment. And in both cases, over here and over here, you need to think about whether the consumers or the firms also have existing loans. And by the way, over here, when we're talking about firms investing, remember, that means that they're buying capital. And if interest rates are very low, they're less likely to want to save their retained profits, and they're also more likely to want to borrow money because it's cheaper to borrow money to buy capital. So that's a little summary of how interest rates work and how they affect consumers and firms.